The Vox Markets Podcast with Justin Waite. Nothing in this podcast is intended as investment advice, and the people in this podcast may hold positions in the stocks they talk about. Do not buy anything based solely on a tip or recommendation. Please do your own research.
Welcome to the podcast on Friday, March the 5th, 2021. On the podcast today, Joe Wiley, CEO of Amryt Pharma, talks through their record full year 2020 results, which saw 18.5% year-on-year revenue growth to $182.6 million. Also the podcast, Andrew Benitz, CEO of Jersey Oil and Gas, discusses the Greater Buchan Area Concept Select Report, which shows the project containing an aggregate 172 million barrels of oil equivalent. Also on the podcast, Russ Mould, Investment Director at stockbroker AJ Bell, talks about the bond market rout or sell-off that's affected the equity market and why it's done so. Also, as always, at the end of the podcast, I have two lists for you: the top 5 most followed companies on Vox Markets in the last 24 hours, and the top 5 most liked or read RNSs too. You can see both these lists at voxmarkets.co.uk. We'll see lots of other content, including Xeros Technology to raise $8 million to accelerate commercialisation of X-filter technology. That's on the front page there. By Fran Rockhopper Exploration as well. Stuff there. Blue Star Capital, Elevator Pitch. STX Energy extends production. And of course, check out our COVID-19 index. The biggest rise today is E Therapeutics, up 7.5%, 23 pence, or 24 pence closely. And biggest faller, Tech Capital, down 6.5% to 14.5 pence. Check that out at voxmarkets.co.uk.
Vox Markets is an online community of investors that runs a free mobile and desktop platform that allows you to track news and updates about any UK-listed company, offering RNS push notifications, detailed charts, pricing data, and much more. Find out more at voxmarkets.co.uk/app.
And joining me on the podcast right now is Joe Wiley, CEO of Amryt Pharma. AMYT is the ticker there. Joe, thanks for joining me.
Thanks for having me, Justin.
Yeah, and you've just announced record revenues for the full year 2020. We'll dig into that and get a bit of detail in a bit. Before we do, as always, Joe, if someone's listening and not familiar with Amryt, just give them a quick summary as to what the company's about, please.
Sure. We're a global commercial biopharmaceutical company focused on rare and orphan diseases. Our strategy is to acquire, develop and commercialize, and we are an unusual biotech in that we are EBITDA positive and cash generative.
Excellent stuff. And so the results, the record results today, 18.5% growth in revenues during 2020, having raised guidance twice in 2020. You're now guiding revenue to grow in 2021 of between 9 and 12%. Is that sustainable, Joe, going forward?
Absolutely, yeah. So we're very pleased, Justin. When we had a number of significant events in 2020. Firstly, we integrated the Algerian business that we acquired in September 19 very successfully and turned our business EBITDA profitable and cash generative, as I've said. Secondly, we listed on NASDAQ, so we're now dual listed on both AIM and on NASDAQ. And thirdly, we delivered positive data, phase 3 data in EB, and we're the first company in the globe to do that in what is thought to be north of $1 billion market opportunity. In terms of the question you asked about sustainability, we delivered 18.5% growth year over year, delivering $182.6 million in total revenue for 2020. To put that in context, when we first joined NASDAQ, we issued guidance of $170 to $175 million for the year. And in Q3, we upped that to between $180 and $182 million. And we're pleased to have actually come in just ahead of that at 182.6. If you look at our two products, metroleptin, which treats lipodystrophy, and lamictal, treating HoFH, lamictal grew 10% year over year, and metroleptin grew 25% year over year. And we expect that growth to continue, with metroleptin very much driving future growth. And we're pleased to issue guidance today of between $200 and $205 million for FY21.
Excellent stuff. Okay, and it's odd, you're unusual. You're biotech, you're growing revenues, profitable, cash generative. So how is that? How are you doing that?
Well, so we are EBITDA profitable. So we generated 30.4 million in EBITDA for 2020 and generated $26.8 million in cash from operations during the period. How we've done that is that we've built a global commercial business. So having acquired Agerian in September 16, that gave us the two commercial assets, metreleptin and lamiptide, and we've built out a full commercial infrastructure now across the US, across Europe, across the Middle East, Latin America, and then with a distributor network beyond that. And that, we call that our commercial engine. Now we have that in place. It's effectively primed and ready for growth. So we are able to sustainably grow this business now because we're already throwing off cash. And as we grow our revenues, and we'll do that in four ways. One, through organic growth of those two launched assets. Two, we will seek label expansion for those launched assets. Three, we'll deliver our own products through our pipeline, and we'll talk about Oleogel S10 in EB. And then four, to continue our strategy to in-license, to acquire, develop, and commercialize products. So those four growth drivers, as we grow our top line, because we have that infrastructure in place, the incremental cost of adding new products is relatively small, and therefore that really drives EBITDA and cash generation into the future.
Understood. And as far as news flow is concerned, what should investors be looking out for, as far as developments in the short term then, Joe?
Yeah, the major news items are as follows. So Oleogel S10, which if it's approved will be known as Filsavez, is our product that showed positive phase 3 data in EB, the first company in the world to do that. That is a massive market opportunity, and it's a truly horrific disease for which there's no approved therapy. So these kids have nothing right now, and we have the first positive data in that indication. We are seeking approval for that this year. We will have submitted to both the FDA and EMA. We're on track to do that by the end of March. And then, all going well, we could have a decision by the FDA in November, and if that's approved in November, we'll then go and launch in December in the US. We expect that the EMA will take a little longer, and if approved, we'll launch in early 2022. So that's a huge value driver for shareholders to watch out for. In addition, we are, for our two launched assets, there are two opportunities. For lamiptide, we are conducting a study in a new disease called FCS, and we expect to have data on that imminently, so investors should look out for that. And then for metreleptin is approved in Europe to treat generalized lipodystrophy or GL, and also partial lipodystrophy or PL. In the US, it's only approved in GL alone. So we're talking to the FDA about doing a study in PL to potentially get a label expansion in the US. And we should have feedback from the FDA on that shortly as well. So there's quite a lot of news items coming up.
Yeah, absolutely. And you've done some sort of interesting deals in the past. Are you still active in the M&A, and what type of products or companies are you looking out for then, Joe?
Yeah, so because we're cash generative, we have grown our cash balances. We have $118.8 million in cash on our balance sheet as of the end of December. And as I said, we're growing those cash balances, and that gives us flexibility to look at doing interesting things. So we have grown our business through acquisition to date. As you say, we've done some interesting transactions, which has allowed us to grow through acquisition. We have a business development function within our business dedicated to looking for new assets. We're looking for what we call peri-launch assets, which are assets which are close to market or maybe already on the market. And we are very busy on that front. We have grown by acquiring, developing, and commercializing, and we intend to acquire further assets either through in-licensing or M&A.
Excellent stuff. Okay then, and what capacity then do you have to take on more products at this point?
Yeah, so as I said, we've built that commercial infrastructure. So the incremental cost to us to add extra commercial assets is actually relatively small. versus companies who would have to go and build out all that infrastructure. We have it now already built and in place, and that's very compelling for potential partners because we can extract a lot of value from that existing infrastructure. The incremental infrastructure required, for instance, for all the OGL S10, if that's approved, the incremental cost is really small. It's the addition of a small number of extra reps, which will allow us to go and launch that. So we have the capacity and the infrastructure built, and as I said, primed and ready, in fact, for new assets. We're very excited about where the company is right now. Having built that, we see that as a good inflection point that can really bring in new products and drive top-line revenue and then contribute significantly to EBITDA and cash generation.
Yeah, absolutely. Marvellous stuff. Okay, Joe, as always, if someone's liking the sound of your progress you're making here but are not yet following the story, give them those 3 quick reasons why they should hit that follow button on your page and add Amryt Pharma to their watch list, please.
Sure. Well, so we're a biotech company that gives an investor a commercial company that's generating revenues, is EBITDA profitable and cash generative. That's very unusual, but also with the upside of a potential approval in EB, a very large market opportunity with no approved therapy in that indication, and finally a track record of success of acquiring, developing and commercializing products. And we've grown through acquisition, and we expect to continue to do so.
Marvellous stuff. Good to chat to you as always, Joe, and hopefully we'll catch up in the not too distant future. Thanks very much.
Thanks, Justin. Thanks for having me on.
The Vox Markets Podcast with Justin Waite.
And joining me on the podcast right now is Andrew Benitz, CEO of Jersey Oil and Gas. JOG is the ticker there. Andrew, thanks for joining me.
Morning, Justin. Thanks very much for having me on the show this morning.
Yeah, and you've had some news out, and we'll dig into that in a bit. And before we do, I know you're very familiar to a lot of people, Jersey Oil and Gas, but tell us about the company, about yourself. If you could just give us a general background, Andrew, if you could.
Okay, well, Jersey Oil and Gas is a pure play North Sea energy company. We started it around 5 years ago. Our key asset is in the heart of the central North Sea. It's referred to as the Greater Buchan area. It's approximately 120 kilometres offshore of Aberdeen. Within that, our key asset is the Buchan oil field. It's an oil field that has had a prolific history, over 36 years of production, and has significant remaining potential. And we announced that a few weeks ago, a significant uplift on the remaining resources that sit within the Buchan field. So the Greater Buchan area, it's comprises of 3 core oil discoveries: the Buchan oil field that I've already mentioned, and then to the north, the J2 oil discovery, and also the Verbier oil discovery, which we discovered back in 2017. Mm-hmm. So in aggregate, we have discovered and recoverable oil volumes of over 170 million barrels, which is a very material new area hub, which we plan to develop. And in addition to that, the Greater Buchan area also benefits from 4 drill-ready exploration prospects of over 200 million barrels. So in aggregate, we've got a significant new area hub development opportunity. The attributes of the project are that it's a conventional sandstone reservoir. We have a wealth of production data from the Buchan oil field. The oil quality is good quality oil, about 33.5 degree API. The scale I've already referred to, discovered volumes of over 170 million barrels, and also the exploration upside. I'm sure we'll come on to the value of the project, which we updated investors on yesterday. But another good upside for the project is that because it's in the heart of the central North Sea, an area that's been producing hydrocarbons for more than 50 years. We have good infrastructure in close proximity to the Greater Buchan area. And the final point I want to touch on is our ambitions to make it a low carbon emissions development. So we're looking at deploying proven technology, platform electrification, and the opportunity there is that we will significantly reduce our carbon emissions associated with the production phase. In the UK North Sea at the moment, the average average emissions of carbon with respect to production are around 20 kilos of CO2 per barrel. Through platform electrification, we can get that down to under 1. So that's part of our journey to be seen as a 21st century energy company producing hydrocarbons responsibly.
Yeah, absolutely. Well, let's go back to you mentioned you announced an update on your concept select for the Greater Buchan area. So tell us more about the economics of the project then, Andrew, if you could.
Okay, Justin. Well, yesterday we announced a significant update on what we refer to as concept select. So that's the early development planning for the Greater Buchan area. It's an exercise that we've been hard at work for over 18 months on. And the announcement yesterday was essentially telling investors what the cost estimates are for the project to get it into production, and also the value potential. So the numbers that we put out yesterday on a pre-tax cash flow, so the profit of the project going into production is potentially over $6 billion of free cash flow, and the NPV of the project on a pre-tax basis is as much as $1.7 billion. So pretty impressive numbers. The payback on the capex to take us into production is under 3 years. The IRRs on the project are over 25%. And really interestingly, when we go into first production, the operating costs at the plateau production rate, which is going to be north of 35,000 barrels a day, the operating costs are as little as $8 to $9 a barrel. So you can understand the profitability of the project when we get into production. So very compelling economics, I'd say.
Yeah, you mentioned it. Pre-tax NPV $1.7 billion. Your market cap of JOG is around 50 million. So how do you see that changing over time? And presumably, the farm-out process will narrow the gap here, Andrew.
Yeah, that's a very good point, Justin. So I'll leave you with two statistics. So if you divide our current market value by our discovered volumes, we're trading around 30 cents a barrel in the ground today. Our peer group trades roughly between $2 to $4 a barrel, or as much as up to $16 a barrel, depending on where they are in their respective journeys. So big discount, 30 cents a barrel in the ground. If you look at it another way, if you look at the valuations we put out yesterday, if you take our post-tax NPV, $1.1 billion, you divide that by our shares outstanding. On an unrisked basis, that equates to approximately £39 a share. On a pre-tax NPV basis, it's potentially over £60 a share. So a current share price of £2.20 it reflects quite a discount from where we see the value of this project. So quite compelling. In terms of how we plan to narrow that gap, I think that this is the year for Jersey Oil and Gas to unlock the equity value. We've completed the concept select phase, so we've teed up the opportunity of now marketing this to industry, and we're looking for industry partners to come and join us to help unlock the value that we see in the Greater Buchan area, and that will help on two fronts. It'll help provide industry validation to equity investors, with partners joining us in this project, and it also provide a material amount of the funding that is required to take this project forward. So I think this is the year for unlocking that gap in equity value, as you referred to.
Yeah. And so over the next year, what can some investors expect from you then, Andrew?
Well, as I said, this is the year for Jersey Oil and Gas. From my perspective, the project is building momentum. We've completed concept select. We're pushing forward into the next phase of the development cycle, and we are kicking off this farm out to attract industry investors into the project. So I think that's the key. Those are the catalysts for the remainder of this year.
Yeah, absolutely. Okay, Andrew, well, every day in the podcast, I highlight the top 5 most followed companies on Vox Markets. To get on the list, of course, people have to hit that follow button and add you to their watch list. So if someone's listening to this, likes the sound of what you're doing there, but are not yet following Jersey Oil and Gas, give them 3 reasons why they should hit that follow button and add you to their watch list, please.
Well, Justin, I could come up with a lot of reasons. I'll try and keep it succinct. I'd say that the first point is that I do believe that there's an exceptional mismatch between the value of the Greater Buchan area, the numbers that we put out yesterday, versus our current equity value. I do believe that gap will be narrowed through our successful farm-out process, which is imminently launching and will conclude during the course of this year. So that's the first point I would refer to. The second point I'd say is that the Greater Buchan area, what we have worked to, what we have put together, has been an incredible journey. We've increased our discovered volumes by over 40 times in the last 3 years, and we're now sitting on the 5th largest new development in the UK North Sea. So a very exciting material project. And then the third point I touch on is that we are in the prime location in the heart of the central North Sea. We've got a conventional project. We've got very good quality oil. We've got access to local infrastructure. And finally, we're looking to develop this in a responsible 21st century way by making it a low carbon emissions project through platform electrification.
Excellent stuff, Andrew. Good to chat to you, and hopefully we'll catch up in the not too distant future. Thanks very much.
Thanks for your time, Justin. Appreciate it.
The Vox Markets Podcast with Justin Waite.
And joining me on the podcast right now is Russ Mould, Investment Director at stockbroker AJ Bell. You all right, Russ?
Yeah, very well. Looking at the sunshine again here in Brighton today, which is lovely. Though it's a bit fresh.
Yeah.
We'll try and get the lad to play a bit of cricket this afternoon just to get some exercise into him, because he's spending most of his time sat on his Xbox when he's not at school. And when he's at school, he's sat on his bottom as well, poor lad. So
I know the
try
thing.
and play some cricket this afternoon.
Yeah, no, I've got a son, son's 8 and 10, and all they want to do is fortnight pretty much. And I have to get them on the treadmill in the morning, and get them exercising, get them walking the dog as well.
Yeah.
The
lad seems to have lost interest in Fortnite. He's moved back to Forza, I think. Is that right?
Okay. How old is he? Maybe my kids will, at a certain age, will lose, because at the moment they're obsessed.
12, very nearly 12.
Okay, yeah. Mine's 11, so he's pretty still obsessed. Anyway, let's talk about something that's I find a bit dry and a bit boring, but they affect the markets. Is the boring bond world? Now, explain to me. So a couple of questions. First and foremost, right? Why are they having such an effect in the market today? The people are saying it's the bonds that are stressed, or and that's what there's a sell-off in the market. Yeah. So explain the relationship, if you could, Russ, between the bond market and the equity market.
Yeah.
If you could.
Well, first of all, to go right back to square one, what is a bond? In rough, this is not a perfect description, but it's a good one. It's a traded loan, basically.
Right.
So you will buy the bond, and you are therefore effectively lending your money to the borrower, whether it's a government, a supranational body, a company, wherever it happens to be. And the deal is, you lend me your money. You then get a coupon, which is the interest rate, and that is paid in predetermined values at predetermined times. And at the end of the bond's life, its maturity, you get your initial investment back, and you've copped all the interest in between. So, that's the deal. Now, obviously, things can go wrong. The main one being the issuer can go bankrupt and leave you in a hole. But we can come back to what can go wrong. But that's effectively what a bond is.
So if I buy like say a government bond, which is the high quality, most high quality bonds, this was the Treasury, US Treasury bonds. If I buy a 10-year bond, I don't have to hold it for 10 years. I can sell it on. Can I? And is that what trading is? Yeah. So
yes, you can. You can trade it. So you would buy it at, basically, bonds are priced at 100, generally priced at 100. So £100 a bond, yeah? So if you held it for 10 years, you would get 10 years worth of coupons, which at the moment would be, £7, 75, well, it's 0.75% a year, whatever it is. And then at the end of it, you get your £100 back. Now, before the Great Financial Crisis, the 10-year gilt yield was 6%. You'd be getting £6 a year for 10 years, plus you would then get your £100, whereas now you're getting 75p or whatever it is. So it's not a particularly high. But the theory is The UK government has never gone bust, or certainly has not since 1672. So, as you say, it's a low-risk investment. You're good for your interest, and you're good for getting your money back at the end. Whereas clearly with a share, the share price can move up and down, the dividend can be cut. That's the downside of shares. But equally with shares, the share price can go up. Now, a bond's price will move over time, but at the end, so you can trade it. And yeah, professional bond managers will actually look to sometimes aggressively trade bonds, so that if the price goes up, because people think, oh, you know, there's a good yield to be had here, I'll have a little bit of that, then that you maybe have a chance to sell and book a capital gain. But most people, I think, would use bonds as a means of generating income and a little bit of ballast. Now, there are risks. The risks are the issuer goes bust. The risks are that interest rates go up and make the coupon on your bond look a little bit sick compared to what you can get on future issues of bonds. Yeah. Or perhaps the biggest one, inflation. Okay. Because it's all very well you saying, oh, I'm getting a rock-solid 0.75% coupon here, but that's not much cop if inflation's at 2%, is it? Because you're guaranteeing yourself a loss of 1.25% a year. Unless you think that's a good deal relative to, say, you think shares are going to go through the floorboards and everything else is, in which case you might think taking a guaranteed 1.25% loss is a good thing. And also, if you're a pension fund or an insurance company, you need guaranteed income to match your future liabilities, whether it's people's pensions or accidents or people dying or whatever it happens to be. You've got all your actuarial models that will tell you when you think you're going to need to pay out your money, and you need instruments that you think are absolutely rock solid to throw something into the pot. So the insurance companies will use bonds to liability match. So they will be looking for bonds of, in many cases, what they'll be looking for is really long-dated bonds that mature over 10, 20, 30 years' time, because then they know they're going to have the cash in the future to pay back their customers on their policies if they have to.
Okay, question here then. So
why does it matter now?
At the moment, there's been talk about a bit of inflation. First of all, you've mentioned this previously quite a few times when you said when no one's talking about it, be careful, because it could come up and rear its ugly head. So why is now inflation affecting the markets and bonds, and what's going on there?
At the moment, the inflation numbers are still relatively benign. I mean, the last UK inflation number was, 0.7% or something? So, but what you are seeing is signs that it's bubbling up in the back. Commodity prices are up very strongly. Shipping costs are up very strongly. Oil prices are up very strongly. And you're starting to see it come through not so much in the consumer price indices or the retail price indices, but the producer price indices, the PPIs, or factory gate inflation. And we've got numbers coming out from China next week, the US next week, and they are starting to show signs of cost inflation, and companies are now thinking, we're going to have to pass this on at some stage. We can't keep on chewing on this because that's going to start hurting our margins. Yeah. So our markets are thinking, we've not really had much inflation we've had disinflation effectively for the thick end of 40 years. So this would be a major, major change. Why? Because it would mean that the things that have potentially worked brilliantly over the last 30 or 40 years, i.e. my entire investment career and then some, and basically pretty much anybody who's in the market today, it would be a big change. And why did, first of all, people think inflation might be coming? Vaccination programs, massive amounts of fiscal stimulus ongoing. The Biden government's just on the verge of trying to shovel another $1.9 trillion into the US economy. You got Mr. Sunak this week providing additional support to the UK economy at least through to September, October. And also you've still got monetary stimulus. You've still got central banks keeping interest rates very low. You've got them running quantitative easing programs. Money supply growth is running in the double digits. So in theory, when there's more money around, the amount of goods that's being used to being used to buy with that money is not going up. You could start to see prices going up. So that's why markets they're worried about inflation, because it's something that they've not seen. And extreme periods of inflation, like you saw in the 1970s, when inflation was in the double digits, basically it was obviously a horrible time for cash, because interest rates weren't compensating you. You were losing money in real terms. It was a terrible time for bonds, because the coupons, again, weren't compensating you in real terms. Equities offered some protection. I mean, if you look at the James Callaghan, Dennis Healey government of 1974, or Harold Wilson first, then James Callaghan as Prime Minister with Dennis Healey as Chancellor, the FTSE All Share doubled during that 5-year period. But the retail price index rose by 110%.
Okay, yeah.
So you actually lost 9% of your money even holding equities. And what actually did best was gold, because money supply was going up very quickly, whereas the supply of gold goes up very slowly. And basically, governments can print money, but they can't print gold or oil, for example. So generally, when there is a period of a very lofty inflation, hard assets, commodities, property have historically done better than paper claims on assets like shares and like bonds, for example. So that's one thing that people are thinking about. So then it's, well, the bond market's getting a bit itchy, so the equity market's getting a bit itchy, and there are three reasons for that. Yeah. One, if bond yields go up, they start offering a higher coupon or interest rate, and that maybe means that equities are a little bit less attractive, because if the yields go up, you might get a little bit more yield for a little bit less risk on your bonds relative to equities. Mm-hmm. Second, bond yields go up. They are the benchmark of which all debt is priced. So when companies issue new debt and new borrowings, they might have to offer themselves a higher interest rate to attract buyers. So then higher interest costs mean lower profits. Yeah. And then the third one's a bit trickier, a bit techier, but with companies that, like Deliveroo, which has just announced its London float, for example, that are in theory still quite young, and they're at the moment in customer acquisition mode, spend mode, investment mode, with the theory that over the next 5, 10, 15, 20 years, they've got all these loyal customers, will keep buying from them, and they will eventually start whacking loads of profit. But those profits are very, very back-end loaded. So how do you value that when you've got losses today, or you did until recently, profits in the future? Analysts will run what's known as a discounted cash flow model. They'll put in a future growth rate, they'll put in what they think is a sensible operating margin for the business to establish what they think the profits might be in 10 or 20 years' time. And then to try and work out what that means for the share valuation now, they will discount back the future profits using an interest rate to give what's known as a net present value. Mm-hmm. So naturally, just the maths tells you the lower the discount rate, the higher the value of the future profits, the higher the share price could go. Yeah. So if the discount rate goes up, the lower the value of your future profits, the potentially lower valuation you can attach to the equity. So as interest rates go up, the maths of it suggests that those companies who've got the most, potentially future profit potential, tech companies, biotech companies, early stage companies, the things that have basically done brilliantly for the last 5, if not 10 years, they're the share prices that in theory could start to come under pressure. And that's what you've seen. You've seen it with, Scottish Mortgage Investment Trust. You've seen it with, which owns a lot of these fantastic tech companies like Tesla or whatever. And they're the sort of companies that share prices have come under the greatest pressure. And that's the maths behind it. And then the other two are obviously a little bit more grounded in terms of, well, it might suck money away to a different asset class, or it might just mean that companies have to pay more to borrow, so their earnings are a bit lower. So those are the three major reasons why.
Yeah. So it's not sort of again, it's not that straightforward, is it? It could be many, as in with all financial things.
And of course, the market could be wrong. Yeah, and the market could be wrong because we have had inflation fears in the past, 2015, 2018, and they came to nothing. I think what's got people on edge this time is that you've got so much stimulus being thrown at the global economy. I think the last Bank of America Merrill Lynch survey I saw was that over 20 trillion of stimulus had been applied to the global economy, and there's more been thrown in since. When the actual loss of GDP last year was about 10 trillion. So there's huge amounts of money sloshing around. You've got some people who are arguing that there'll be inflation because there's going to be supply side destruction. Businesses will close down, people will get out, there'll be less supply, their input costs have gone up because of tariffs or because of oil or cotton prices or shipping costs, and companies will look to pass that on. You've got some people who said, no, it's all a head fake. It's not going to happen because there's too much debt in the world, and that is inherently deflationary. That means interest payments suck money away. Demographics, you've still got a population that's getting older that wants to save more, not spend more. Mm-hmm. And you're going to see demand-side destruction because unemployment's going to go up. So that nobody knows, but I think what's got markets on edge is the US Federal Reserve is saying we want to let the economy run hot. Yeah. We've got a 2% inflation target, but we're actually going to average that out. Okay. So if we undershoot for a while, we'll let it overshoot for a while with the net result that over a period inflation's 2%. Now, if you put a chicken in the oven and undercook it, and you then cremate it to try to make up the difference, the result's not only that good, is it? So I think on that, I think that's what's got markets worried, is that they've been able to they've really struggled to create inflation for the last 10 years. Yeah. Who's to say they can rein it in at the flick of a switch if it does start to move around? And I think that's what's got markets on edge. And Jay Powell, the Fed chair, has been like, actually, we're just going to let it run hot, okay? Suck it up. Yeah. And we think that's a risk worth taking relative to the economy tipping over into a recession. And listening to Mr. Sunak this week in the papers, reading the papers, the fear in the here and now is rising unemployment and almost a double dip recession. Yeah. Markets are thinking one step ahead of that, which is if they just keep throwing money at it at some stage, on balance, and people are allowed out, and those who are lucky enough to have kept their job and not be furloughed can go out and spend. The market's thinking, actually, you might get something unexpected here, and it's always the unexpected that, as we said, is what really moves markets. Yeah.
So essentially, again, the market's trying to correct a little bit, isn't it? I suppose, and like I said, normally they overcorrect. What's odd though is we talk about hard assets that the central banks can't print or make, and you've got gold there now. It's like it's over a 7-month low. It's really rolling over the price. What's going on there? It never sort of the markets altogether never form a complete picture and say that makes sense. Some parts of it don't make sense, and other bits do, and it's odd.
Not expected gold to have done better. I think some people are arguing that Mr. Bitcoin has scooped up some of the gold demand. Some of the gold demand. I think there is some element of that. And silver's actually outperformed gold stone cold, so that's possibly where some of the money's going as well. And silver is cheap relative to gold. If you divide the gold price by the silver price, the historic average is about 55 times, and then last time I looked, gold was still trading above that. So people have probably latched onto silver a little bit more. Mm-hmm. Gold miners are absolutely in the doghouse right now. They've actually been increasing dividends. They've been showing very rapid profits growth, but actually the market's just completely ignored them. So again, if you're looking to nose around in areas where nobody's looking, that might be an area that's worth doing a little bit of investigation in. I know miners are fiendishly tricky. I was taught as a very junior analyst starting work in the market in 1991 that the definition of a mine was a hole in the ground with a liar at the top. So I think my head of research had obviously had a pretty jaundiced view of miners, generally speaking. And the danger that you have with miners, particularly junior ones, is they keep on sucking up money and dilute you down. So I think if you do go into mining, you probably need a basket of them, big ones, little ones, or there are funds that do it, or there are ETFs and trackers that will get you a basket of either big cap miners or little cap miners, so you can choose the risk profile that you want for yourself. Yeah. But miners can be tricky, and things can go wrong. Landslides, bad weather. The local government can decide, actually, you're making a boatload of money out of a gold mine, so we'll tax you more. Resource nationalism. So there are lots of things that, or they just decide they need more money to dig more holes. So there are lots of things that can go wrong. So oddly enough, sitting on a gold mine isn't always as easy a path to money as it sounds. But if your cost of production is $900 an ounce, and the gold price goes from, say, $1,500 to $2,000, that extra $500 an ounce of price, it's just pure profit by and large. So they are very highly geared into the gold price. That generates cash, and that then generates dividends. And some of the gold miners are starting to chuck out some quite generous dividends right now.
Yeah. It's funny, so where the precious metals are in the world, you generally wouldn't want to start a business there in those kind of jurisdictions. And that's always very tricky. It's quite risky, isn't it? Some of them.
Yeah, I think if you look at the gold miners, you need to look at where they operate. I mean, some of the big ones like Newmont and Barrick have actually got big mines in Canada and to a degree America. So I think that gives you a little bit of reassurance. It's when you start going a little bit more off the beaten track. And Australia is another huge area for gold mining. For example, there are some Russian quoted companies, but there are a lot of gold mines in Africa, and some regimes there are probably easy to work with than others, I would politely suggest.
Yeah. And so one final thought for people at the moment not understanding that they've started investing recently, maybe they're holding stocks and they're seeing just a screen full of red there. I mean, what's the thought there? It's just a temporary blip. It's just, this happens. I mean, these things happen. It's funny, when they do happen, we all say, oh no. But we look back at it. I mean, we are investing in one of the biggest sell-offs, fastest sell-offs ever back in March 2020. And look, we rebounded from that and it's gone higher. And so it's always, when we're in the jaws of the sell-off, it's always a lot more worrying, isn't it? Because when you pull away from it, you think, oh, that wasn't so bad, actually. So, but it'll rebound.
It's generally time to start doing your homework and having a look. I think what it might also be telling you is that we may be seeing, again, a change in market leadership, and that we have been used to these techie growth stocks, momentum stocks leading the way for the last 4 or 5 years. They all have done brilliantly. They're often very good companies, but they're now very highly valued, and they offer growth well into the future, if you do get a decent economic recovery, the markets might move away from jam tomorrow to jam today and look at cyclicals and recovery stocks. It might just be an issue of market leadership changing rather than markets being doomed to a long period of a period of heavy falls. But we've had a phenomenal recovery over the last 12 months, and some bits of the market do look very frothy. Whether it's IPOs, whether it's SPACs, whether it's GameStop, or certain areas just do look hot and sweaty.
Tesla, for example, just literally going north. I mean, the share price was literally stratospheric, and when we say share prices it don't go straight up, it was, and then it had a little pause, and then went up further, and people said, it was overvalued like a few months back, and then I saw brokers give it a sell on when it was about $400. And then say it was a buy at $800. What are you talking about? So it's very odd, isn't it?
That's just the pressure of that's how markets. When if anything, what you need to call the top is the wet towels to come slopping into the ring from those people who've got it wrong, and that's often when the share price will turn, because once everybody's turned bullish, there's nobody left, is there? So exactly. I think we probably are due a bit of a bobble, because we have had such a stunning run, and the economic picture is a little bit unclear. And if you do get what would be a generational shift from disinflation to inflation, you will see a lot of market volatility and a big change in market leadership. So it's potentially a very pivotal, sort of period that we're entering right now.
Yeah. Marvellous stuff for us. Have a nice weekend. And we'll
you too.
Speak next week, hopefully.
I look forward to it.
Okay, it's time for the top 5 most followed companies on Vox Markets in the last 24 hours. They are at 5, Medgedale Capital. That's MAC ticker down 9%, 2.05. Big fall yesterday as well, so compounding that. Plutus Power Gen up 6%, pretty much 0.045. At 3, Origo Partners up 40%, 0.3. At 2, Europa Oil and Gas up 10% to 1.6. And at 1, Mountfield Group up 1.6 to 0.305. Okay, top 5 most read RNSs in the last 24 hours are: at 5, Horizontal Minerals, appointment of John Broker. At 4, Braveheart Investment Group, replacement. Boring. At 3, Arc Minerals Limited, appointment of financial advisor. At 2, Holdings in Company, Amigo, because these are boring, aren't they? At 1, Braveheart, sale of shares by PDMR. Well, I apologise, they're not the most interesting of updates, but that's what they are. People are reading those RNSs. That's it for the podcast. Thanks for listening. Muchos apreciados.
The Vox Markets Podcast with Justin Waite. Nothing in this podcast is intended as investment advice, and the people in this podcast may hold positions in the stocks they talk about. Do not buy anything based solely on a tip or recommendation. Please do your own research.